What's going on, everyone, and welcome back to the channel. Let's talk about the markets, because something wild is happening with silver. If you thought 2024 was a roller coaster, you haven't seen anything yet. In just the first quarter of 2025, silver has absolutely exploded, leaving gold and even Bitcoin in the dust. We're talking about a price surge that has analysts scrambling to update their forecasts. So, what's fueling this incredible rally? Well, it's a perfect storm of factors. Industrial demand, especially from the booming solar and electric vehicle sectors, is at an all-time high. At the same time, we're seeing major supply chain disruptions and a growing number of investors looking for a safe haven asset. This isn't just a small jump, it's a seismic shift in the precious metals landscape. What do you think is next for silver? Let me know in the comments below, and don't forget to subscribe for more updates. What followed was not a small rally. It was not a normal price cycle. Over the course of the year, silver climbed above $70 per ounce. The move represented a gain of more than 130%. For experienced market observers, such a rise could not be dismissed as random volatility. They understood that price movements of this scale usually signal deeper forces at work. Serious decision makers began asking a different question. They were not asking why silver was rising for a few weeks. They were asking what structural shift had caused the market to reprice the metal so aggressively. Part of the answer lay in silver's unique identity. Unlike gold, which is held mainly as a store of value, silver lives in two worlds. It is both a precious metal and an industrial input. Roughly 60% of its demand comes from industrial uses. Solar panels, electrical systems, and advanced electronics depend on it. This dual nature makes silver more sensitive to changes in manufacturing and energy policy. In 2025, global industrial demand accelerated. Solar production expanded as countries pushed forward with energy transition targets. Manufacturers increased output to meet infrastructure and electrification needs. Each solar panel required silver paste to collect and transport electricity. As production volumes grew, so did physical consumption of the metal. This was not speculative demand driven by fear. It was operational demand driven by production lines. At the same time, the gold to silver ratio began to compress. For years, gold had traded at a much higher multiple relative to silver. In some periods, the ratio exceeded 100 to 1. By late 2025 and early 2026, the gap narrowed to levels not seen in 15 years. Ratio compression often signals capital rotation. It suggests that investors are reassessing relative value between assets. Institutional participants notice this shift. When a ratio moves that significantly, portfolio managers adjust. Some reduced overweight positions in gold and increased exposure to silver. Others entered silver markets for the first time, viewing it as undervalued relative to both gold and industrial metals. Volatility increased as this repositioning unfolded. Prices did not rise in a straight line. There were sharp pullbacks, there were rapid recoveries, yet the broader trend remained intact. The market was not simply reacting to headlines, it was recalibrating expectations. For entrepreneurs and business leaders, the signal was clear. A 130% move is not merely a trading opportunity, it is a warning. When an input metal reprices that dramatically, cost structures across industries may change. Procurement strategies must adjust. Hedging policies may need revision. Silver's breakout also challenged an old assumption that it would always remain secondary to gold. Markets do not respect hierarchy. They respect supply, demand, and policy risk. When these forces align, even overlooked assets can take center stage. By the end of 2025, silver was no longer an afterthought. It had become a case study in structural repricing. Observers who had ignored it were forced to reconsider. Those who had studied industrial trends understood that the move was not random. It reflected deeper economic currents. The question now was not whether silver had risen. The question was whether this repricing marked the beginning of a longer transformation in the metals complex, or whether it was the first stage of a new and more volatile era for industrial commodities. Have you been watching silver prices bounce around like a roller coaster lately? Let's break down what's been happening. A few weeks ago, the market got spooked by talks of a potential U.S. review of trade policies, specifically targeting certain solar products. Since silver is a key component in solar panels, the price took a nosedive, dropping nearly 4% in a single day. Everyone was bracing for new tariffs, but then, plot twist. The review concluded with no new tariffs. The market breathed a huge sigh of relief, and silver prices shot right back up, recovering almost all of their losses. This whole episode just goes to show how sensitive silver is to political news. But underneath all that noise, the fundamental demand for silver, especially in the booming solar industry, remains incredibly strong. It's definitely a market to keep an eye on. Thanks for watching, and don't forget to subscribe for more market insights. Hey everyone, and welcome back to the channel. Today, we're diving into a hot topic: how the Federal Reserve's latest moves are shaking up the silver market. You've probably heard all the talk about interest rates and inflation, but what does it actually mean for the price of silver? Well, it's a fascinating tug of war. Historically, when the Fed signals tighter monetary policy, it can strengthen the dollar, which sometimes puts pressure on silver prices. However, with all the economic uncertainty right now, many investors are also looking at silver as a safe haven asset, a reliable store of value. So, are we seeing a dip or a surge? The data shows some surprising trends that you, as an investor, absolutely need to know about. We're seeing a real battle between industrial demand and investment demand. Stay tuned as we break down the charts and what experts are predicting for the coming months. Don't forget to like and subscribe for more insights. Because it is critical to renewable energy and advanced manufacturing, governments may treat it as strategic. Strategic assets attract regulation. Regulation introduces volatility. At the same time, the Federal Reserve's leadership transition demonstrated how quickly confidence shifts can reverse capital flows. A stronger dollar can drain momentum from precious metals. A weaker dollar can amplify it. Silver's 2025 experience showed how exposed it is to these crosscurrents. For business decision makers, the warning is direct. Price spikes and crashes are not random episodes. They are reflections of structural forces. Companies that depend on silver must consider policy scenarios, not just supply forecasts. The market in 2025 delivered a clear signal. Silver's breakout was not purely industrial. It was amplified by uncertainty. And uncertainty, in the modern economic landscape, is not disappearing. The question facing strategic leaders was no longer whether silver would remain volatile. The question was whether volatility itself had become part of its new normal. By late 2025, silver was no longer rising quietly. It had become a central topic in boardrooms tied to manufacturing, renewable energy, and technology. Executives began asking a serious question. What happens when the very demand that pushes prices higher starts to reshape the industry itself? Silver's supply structure offered the first clue. Unlike many commodities, silver is rarely mined alone. In most cases, it is produced as a byproduct of mining other metals such as copper, lead, or zinc. This means that even if silver prices surge, miners cannot instantly increase output. Production depends on the economics of those primary metals. This creates what economists call supply inelasticity. When demand accelerates, supply cannot respond quickly. Prices rise sharply as a result. That dynamic was clearly visible during the 130% breakout. Industrial consumption increased, but production did not expand at the same speed. For a time, this imbalance favored higher prices. Solar manufacturing played a critical role in this equation. Each photovoltaic panel requires silver paste to conduct electricity efficiently. As governments expanded renewable energy targets, solar installations grew rapidly. With each new installation, physical silver left the market and entered long-term industrial use. This was not speculative accumulation. It was functional absorption. However, there is a paradox in commodity markets. When prices climb too aggressively, they begin to influence behavior. High prices encourage innovation. Innovation can reduce dependence. By early 2026, manufacturers were already discussing thrifting strategies. Thrifting refers to reducing the amount of silver used in each unit without compromising performance. Even small reductions per panel, when multiplied across millions of units, can significantly lower total demand. More importantly, alternative technologies began gaining attention. Cadmium telluride thin film solar technology offered a pathway to reduce or even eliminate silver usage in certain panel designs. While not yet dominant, the technology represented a strategic threat. If adoption widened, long-term demand assumptions for silver could shift. This is the industrial trap. When prices surge because of strong demand, they signal profitability to producers, but they also signal cost pressure to consumers. Consumers respond by seeking substitutes or efficiency gains. Over time, the substitution can erode demand growth. Market strategists understood that silver sits in this delicate balance. It benefits from electrification and renewable expansion, yet it is not immune to technological displacement. For entrepreneurs and investors, the lesson is practical. Commodities linked to innovation cycles do not move in straight lines. Their long-term demand depends not only on usage, but on adaptability. If silver remains affordable relative to alternatives, demand remains stable. If prices remain elevated, research and development accelerates. There is another structural concern. Because silver production depends on other metals, its output is indirectly tied to global industrial conditions. If copper or base metal mining slows due to economic weakness, silver supply may contract further. This can amplify volatility in either direction. The breakout of 2025 highlighted this vulnerability. Strong demand tightened balances. Limited supply flexibility magnified price movement. But elevated prices also planted the seeds of adjustment. Substitution trends, once started, are difficult to reverse. Strategic planners now faced a dual scenario. In the short term, constrained supply could support a higher floor for prices. In the long term, technological shifts could cap the upside. Silver's surge was therefore not just a story of growth, It was a case study in tension between scarcity and innovation, between expansion and efficiency. For decision makers, the warning was measured but clear. Success in commodity markets often carries its own risk. When a material becomes expensive enough to force change, the market eventually adapts. The critical question was whether silver's demand growth would outpace substitution, or whether its own breakout had already triggered the next phase of adjustment. As silver entered 2026, analysts began to shift their focus from the breakout itself to a more difficult question. Where does silver find stability after such a dramatic move? Gold offered a useful comparison. Gold benefits from a structural buyer base that silver does not possess. Central banks across the world purchase gold as part of their reserve strategy. They buy it to diversify away from the US dollar. They buy it as protection against inflation. They buy it because it carries no counterparty risk. This steady institutional demand creates a form of baseline support. When prices fall, central banks often step in. Silver does not enjoy that same privilege. There are no consistent central bank accumulation programs for silver. Its demand profile is more fragmented. It relies on industrial consumption, investor flows, and retail participation. This makes its price more reactive. When investment appetite is strong, silver can outperform gold. When confidence fades, it can correct more sharply. The structural difference matters for strategic planning. During the 2025 breakout, investment flows amplified the move. Exchange-traded funds saw inflows. Traders increased exposure as the gold-to-silver ratio compressed. Momentum attracted additional capital. But unlike central bank buying, this type of participation is not permanent. It can reverse quickly. The absence of a structural dip buyer introduces vulnerability. Have you ever wondered why the price of silver can swing so wildly? Let's dive into the fascinating world of the silver market. Unlike gold, which is mostly used for investment, over half of all silver is used in industry. Think solar panels, electronics, and even medical equipment. This industrial demand makes its price super sensitive to the global economy. When factories are humming, demand for silver goes up. When they slow down, demand drops, and so does the price. Now, here's where it gets really interesting. The massive and growing demand from countries like China and India is a huge driver. As their economies expand and more people enter the middle class, the demand for consumer electronics and jewelry skyrockets, pulling global silver prices along with it. So, the next time you see silver prices moving, you'll know it's not just about investors. It's a story of global industry and economic growth. Thanks for watching, and don't forget to subscribe for more insights. That massive 130% breakout for silver in 2025. It wasn't just a milestone, it was a serious warning. It showed us exactly how fast markets can react when supply, policy, and demand all hit at once. But it also proved how shaky that momentum can be without big, consistent buyers. So where does silver stand now? It's at a crossroads. It's built a solid new foundation thanks to its critical role in industry. But how high can it really go? That depends on everything from government policy and currency values to new technology and where global money is flowing. For serious investors, the takeaway is clear. Silver is no longer that forgotten metal collecting dust. It's now a strategic piece of the global economic puzzle. In a world full of sudden policy shifts, tech leaps, and geopolitical tensions, you have to watch these strategic variables closely, because their next big move rarely gives you a heads up. Thanks for watching, and be sure to subscribe for more insights.